Let's start with the basic question. What exactly is an ESOP? An ESOP or Employee Stock Ownership Plan is a tax-qualified retirement plan designed to give employees an ownership stake in the company they work for. Here is how it works. A company sets up a trust and contributes either cash or company stock into it. These contributions are tax deductible for the company. Over time, the trust allocates these assets, mostly shares, to individual accounts. When employees retire, leave the company or pass away, they receive the value of the stock allocated to them, either in shares or most commonly in cash if there is no public market for the stock. In that case, the company buys the shares back. What makes ESOPs unique is that they can also be used as a financial tool. The ESOP trust can borrow money from the company, its owners, or even external lenders to buy company stock. And here is the key. The company can make tax-deductible contributions to the ESOP to help repay that loan. That includes both principal and interest. It is a tax-efficient way for a business to transition ownership, raise capital, or reward employees. Companies can also contribute stock directly to the ESOP without using cash and still enjoy tax benefits. This strategy not only saves money but also helps grow the company's value and profitability over time. And that in turn builds wealth for the companies without reducing the wealth of existing owners. So in simple terms, the company contributes stock or cash, the ESOP trust holds and allocates those assets, the employees receive value over time, and the company gets tax benefits along the way. That is the core concept of ESOP, turning employees into owners while creating real financial advantages for the business. Now, here is a refined and informative version why companies offer ESOP, saving jobs and driving growth. One powerful reason companies adopt employee stock ownership plans, ESOPs, is to preserve jobs, especially in critical moments like ownership transitions, relocations, or when facing economic uncertainty. First, we have facilitating employee buyouts and succession planning. ESOPs are increasingly used in leverage buyouts, LBOs, when business founders retire or plan to sell. Rather than looking for outside buyers who might structure or dissolve operations, owners may transfer the company to its employees through an ESOP. This keeps the company intact and retains local jobs. Preventing job loss due to relocation. Sometimes corporations consider moving the regions with better economic conditions or cheaper labor. In such cases, an ESOP-backed buyout by employees can help prevent large-scale unemployment in the original location. Support from government and unions. Local and state governments often encourage and help fund employee buyouts to avoid job loss and economic disruption in their regions. Even labor unions support ESOPs, sometimes agreeing to wage reductions or employee investments to help finance the buyout, ensuring long-term job security and economic participation for their members. Aligning interests and sharing wealth. Through ESOPs, employees don't just become workers, they become co-owners. This ownership drives higher commitment, accountability, and productivity, as employees directly benefit from the company's success. Most ESOPs today are established in financially healthy, well-managed companies that are poised for growth. So they are a strategic tool for companies to reward employees without requiring their investment, increase productivity and profitability, reduce tax burdens through favorable tax treatment, circulate wealth within the local economy. Tax advantages. ESOPs offer tax benefits to both the company and employees. While employees pay tax on distributions at retirement or when they leave the company, the long-term cash flow helps circulate money through the economy, creating broader economic gains. And lastly, a permanent pillar of corporate finance. Thanks to their flexibility, tax efficiency, and proven ability to boost productivity, ESOPs have become a mainstream tool in corporate finance, benefiting not just companies and employees but governments and entire communities. Next, we will see ESOP eligibility. Who qualifies? Let's break it down step by step. Who is eligible? To start with, the ESOP, like any other qualified retirement plan, must include all employees who meet the following minimum federal standards. They must be at least 21 years old and they must have completed 1 year of service, defined at least 1,000 hours of work during a 12-month period. But of course, as with most things in law and tax, there are exceptions. So the exceptions to the rules are full vesting plans. If the plan provides 100% immediate vesting, it can require employees to work for up to 3 hours before being included. Seasonal industries. In some sectors, especially seasonal ones, the 1,000-hour rule may not strictly apply. Adjustments are allowed under IRS guidelines. These rules come under Code Section 410, Clause A. When do employees actually join the plan? Employees become eligible to join the ESOP on the earlier of the first day of the plan year after completing the service requirement or 6 months after completing the service requirement. And it's important to note there is no maximum age limit. Older employees who meet the basic requirements cannot be excluded just because of age. Who can be legally excluded? The law allows some specific groups to be excluded from participating. Non-resident aliens, if their income is earned entirely outside the US. Part-time workers who work less than 1,000 hours in a year unless the plan opts to include them. Or union employees if requirement benefits have been negotiated through collective bargaining. So there is also a rule that requires the plan to meet minimum participation standards on at least 1 day in each quarter. Next, we have the alternative coverage test, that is the alternative route, the percentage test. If a company cannot meet the standard eligibility test, it can instead apply the percentage test to ensure it satisfies the coverage requirement. Here is how it works. At least 70% of all employees must be covered by the plan. The ratio of non-highly compensated employees, NHCEs, covered must be at least 70% of the ratio of highly compensated employees, HCEs, covered. There must be no discriminatory classification favoring HCEs. The benefits contributed for NHCEs must equal at least 70% of those contributed for HCEs. A highly compensated employee is typically someone earning $85,000 or more as defined under Section 410, Clause B. Next, we'll see the SLOB rules, separate line of business exclusion. Now, there is another exception under Code Section 401A, the SLOB rules. That stands for separate line of business. Employees can be excluded from the ESOPs if they work for a division of subsidiary that is in a separate line of business and has at least 50 employees. However, this exclusion must be applied fairly and consistently. It cannot be used as a workaround to discriminate against rank and file employees. Special exclusions under Code Section 104, Clause 2. This is important. If a shareholder sells their stock to the ESOP and chooses to defer capital gains tax under Code Section 1042, then the shareholder, certain family members, and any individual owning 25% or more of the stock are excluded from participating in the ESOP. And we also have the breaks in service. If an employee fails to complete at least 501 hours of service in a 12-month period, they may be considered to have a break in service and lose their plan participant status. To regain eligibility, the employee must complete a full year of service again. What about the controlled groups shared eligibility? If a company is part of a controlled group, meaning it has common ownership with other companies, the eligibility rules apply across all entities. A control group exists when A parent company owns 80% or more of the stock or voting power of another company, or 5 or fewer individuals own 80% of more across multiple corporations with identical ownership patterns. All members of a control group must follow the same eligibility testing rules. Next, understanding vesting. What is vesting in ESOPs? Vesting in ESOPs, employee stock option plans, refers to the process by which an employee earns the right to own the shares or stock options granted to them by the employer over a defined period of time. Until the vesting conditions are fulfilled, the employee does not legally own or control those shares. In simpler terms, vesting is like earning your reward slowly. Even if a company grants you 1000 stock options on day 1, you don't own them immediately. You gain ownership over time as per the vesting schedule. The purpose of vesting: to retain employees over the long term, to align employee interests with the company's growth, and to discourage early exits. What about the vesting period versus cliff period? These two terms are closely related but mean different things. What is vesting period? This is the total time over which the employee becomes fully entitled to their granted ESOPs. For example, if an employee is granted 1000 shares with a 4-year vesting period, they will fully own all 1000 shares after 4 years, assuming continuous employment. What about cliff period? This is the minimum initial time the employee must work with the company before any shares begin to vest. If the employee leaves before the cliff, no options vest. And once the cliff is crossed, a lump sum of options may vest. Example, let's say you are granted 1000 ESOPs with a 1-year cliff and 4-year vesting. You will vest 0 shares until you complete 1 year. On your first anniversary, 25% or 250 shares vest at once. After that, the remaining 750 shares will vest monthly or quarterly over the next 3 years. Next, we have the types of vestings. We have 2 types of vesting, that is graded vesting and cliff vesting. First, we will see what is graded vesting. Graded vesting. In graded vesting, the options vest gradually over the vesting period. This can be monthly, quarterly or annually, often after an initial cliff period. Example, 1-year cliff plus graded vesting. We will have year 1, 25% vests after the cliff, year 2, 25% more vests, year 3, 25% more vests, year 4, remaining 25% vests. This is the most common vesting structure, providing partial ownership each year. What about cliff vesting? So in cliff vesting, 100% of the options vest at once after the full vesting period or after a set cliff period. Example, 1-year cliff and 1-year vesting. 100% vests at the end of 1 year. 4-year vesting with 4-year cliff, 100% vests at the end of 4 years. This is riskier for employees since they receive no benefits unless they stay until the end. What about the legal minimum vesting under Indian law? Under Indian company law and SEBI guidelines, particularly for listed companies, there are specific rules for ESOPs. Minimum vesting period. 1 year is the minimum legal vesting period for the date of grant. This means no ESOPs can legally vest before 12 months of continuous service. This applies regardless of whether the company is private or listed. Other Indian legal requirements. The ESOP plan must be approved by the board and shareholders. Vesting schedules must be clearly mentioned in the ESOP policy and grant letters. In case of termination due to misconduct, unvested options are forfeited. And in case of death or disability, many companies allow accelerated vesting. Note that while the law provides a minimum, companies can choose more employee-friendly vesting terms like graded monthly vesting, longer total vesting periods, etc. Let's now understand the vesting schedules better through 2 real-life style examples. These will help you visualize how vesting actually works in practical terms. Example 1, time-based vesting, 1 year cliff plus 4 year graded vesting. Let's say Anita joins a tech startup on January 1, 2024. As part of her employment offer, she is granted 4,000 stock options under the company's ESOP. Now, the company follows a 1-year cliff followed by 4-year graded vesting schedule. Here is what that means. The cliff period is 1 year, so Anita won't vest any stock options until January 1, 2025. If she leaves before completing 1 year, she gets 0 options. But if she completes 1 year, she vests 25%, which is 1,000 options. After the cliff, the remaining 75%, that is 3,000 options, will vest monthly over the next 3 years, from Jan 2025 to December 2027. So by the end of 2027, if Anita stays with the company, all 4,000 options would be finally vested. Next, we'll go to the example number 2. Performance-based vesting. Now let's look at another example. Rahul, who is a senior sales manager at a mid-sized company. His ESOP grant includes 2,000 options. But instead of a time-based vesting schedule, his vesting is tied to performance milestones. Here's how it works. Milestone 1. If Rahul achieves a cumulative sales target of 5 crore rupees within 18 months, he vests 50% of his ESOPs, that is 1,000 options. Milestone 2. If he crosses a sales target of rupees 10 crore by the end of 3 years, he vests the remaining 50%, 1,000 options. If he does not achieve the milestones, he does not vest those options. Let's assume Rahul hits 5 crore rupees sales in month 15. He vests 1,000 options. He reaches 10 crore rupees by month 32. He vests the remaining 1,000 options. This kind of schedule rewards performance and encourages employees to stay aligned with company growth targets. Next, we'll see the key clauses in ESOPs. In this section, let's break down the most essential clauses typically found in a well-drafted employee stock option plan or ESOP. An ESOP is more than just a benefit. It is more than just a benefit. It is a strategic tool. It gives employees the right to purchase company shares, usually at a price lower than the market value, aligning their personal growth with the company's success. But to implement ESOPs meaningfully and legally, the policy document must include several key clauses. So let's go through 5 of the most important ones, along with some practical considerations like termination, exit, and buyback. ESOP pool and eligibility criteria. This clause defines how much equity is being set aside for ESOPs, the ESOP pool, and who is eligible to receive them. The ESOP pool is the total number of percentage of shares that the company reserves for employee allocation. Any modification to this pool, such as increasing or reallocating shares, should be approved by the board of directors or other designated authority. The eligibility criteria lay out who qualifies: minimum tenure of years of service, designation or level of responsibility, past performance against goals, or future growth potential within the company. This clause ensures transparency in allocation and helps prevent misuse or bias in granting stock options. Grant of options and vesting terms. This clause governs how options are granted and when they vest. The grant process specifies the number of options offered, the grant price, also called the exercise or strike price, and the grant date. The vesting schedule defines when the employee earns the right to exercise those options. Vesting could be time-based, such as 1 year cliff followed by monthly vesting, or performance-based, where vesting depends on hitting specific milestones. This clause is key to aligning employee interests with long-term business goals and retaining talent over time. Lock-in period and transfer restrictions. This clause limits when and how an employee can transfer, sell, or pledge the shares they receive. The lock-in period refers to a fixed time frame, often 1 to 3 years, during which employees cannot sell their shares. The clause may also prevent transfers to third parties, encumbrances on the shares, any speculative trading. Next we have ESOP committee. Constitution of the ESOP committee. While not legally mandatory, most companies constitute a dedicated ESOP committee to handle operational and governance responsibilities. This committee reviews employee eligibility, approves grant decisions, monitors vesting progress, and oversees compliance with regulatory and taxation norms. And finally, we have the taxability clause. This clause clarifies the tax implications for employees at two key points. At exercise, when the employee exercises their option and receives shares, the difference between the market price and exercise price is treated as perquisite income and taxed accordingly. Next, at sale, when the employee sells the shares, they may face capital gains tax, the rate of which depends on the holding period. So the clause may also include TDS, tax deducted at source, obligations and employee responsibilities. It's crucial for employees to understand this in advance, so there are no surprises during vesting or liquidation. Next, we have other critical clauses to include that we should watch. First, we have termination clause. This outlines what happens if the employee leaves the company, whether by resignation, termination, or death. Typically, unvested options lapse upon termination. In some cases, vested options may have a short window, example 90 days, for exercise. And for termination due to misconduct, even vested options may be cancelled. What about exit clause? Exit clause or early exit provisions. If an employee leaves before completing the vesting period, the policy should clarify whether any acceleration of vesting applies, example in case of acquisition, whether the company will allow partial vesting based on time reserved, or whether options are forfeited or can be bought back. Next, we have the buyback mechanism. Since ESOPs shares are not always listed, this clause defines if and when the company will buy back vested shares, the formula for valuation, example based on audited financials, and whether the buyback is mandatory or optional for the company. This provides exit visibility to employees and makes the ESOPs attractive even in unlisted companies. Next is the legal framework in India. When a company in India wishes to implement an ESOP, it must comply with a well-defined legal framework. This framework ensures transparency, accountability, and protection for both the company and its employees. Let's walk through the key legal components. Firstly, Companies Act 2013. The Companies Act 2013 lays the foundation for issuing ESOPs. Especially Section 62 Clause 1B governs the issuance of shares to employees under a scheme like ESOP. So its key provisions include special resolution. The company must pass a special resolution in a general meeting that is at least 75% shareholder approval to grant ESOPs. Eligibility. ESOPs can be granted only to permanent employees, directors, excluding independent directors and employees of holding or subsidiary companies. Restrictions. Promoters or those holding more than 10% equity in the company are not eligible for ESOPs in unlisted companies unless they are startups registered under DPIIT. Board and shareholder approval. The board of directors must approve the ESOP scheme initially, and then it requires shareholder approval via a special resolution. And finally, disclosure requirements. Companies must disclose details of the ESOP scheme in the board's report and maintain a register of employee stock options granted. Next is SEBI, Share-Based Employee Benefits and Sweat Equity, Regulations 2021. This is applicable only to listed companies. For companies listed on recognized Indian stock exchanges like NSE or BSE, ESOPs are governed by SEBI, SBEB and Sweat Equity Regulations 2021. So its key features include compensation committee. Listed companies must constitute a compensation committee of independent directors to oversee the ESOP plan. Next, mandatory disclosures. Listed entities must make detailed disclosures about ESOPs in their annual reports and on their websites. Next, pricing. While there is flexibility in pricing, the company must disclose the pricing formula for ESOP grants in its plan. Next, lock-in and vesting. Minimum 1 year vesting period is mandatory except in cases of death or permanent incapacity. Repricing clause. If the company wishes to reprice options already granted, it must be done with prior approval of shareholders through a separate resolution. Next, we have stock exchanges, NSE and BSE. Both BSE and NSE follow SEBI regulations but may require additional filings such as intimations at the time of grant, vesting or exercise of options, disclosure of material changes to the ESOP policy, ensuring compliance with minimum public shareholding norms if dilution occurs due to ESOPs. These platforms also ensure companies meet ongoing corporate governance requirements when dealing with ESOP related matters. So we have come to the conclusion of the video. Eligibility. Not everyone is entitled to ESOPs. They are usually reserved for full-time employees, and there are specific legal exclusions such as promoters or directors holding over 10% equity. Vesting. ESOPs are not given outright. They are earned over time through a process called vesting, which legally requires at least 1 year of service. So we actually touched on a lot of topic today. We also touched on how companies structure ESOPs practically through real world examples and simple visuals. But here's the most important takeaway. Before signing an ESOP agreement, always read the ESOP policy thoroughly. Look for key terms like vesting period, exit options, buyback rules, and tax liability. Don't just celebrate the offer. Understand it. If you found this video helpful, like the video, comment below with your questions, especially if you want decoding your ESOP letter. Subscribe to stay updated on future videos. Coming up next is a landmark labor law case that every working professional should know. Thanks for watching and see you in the next one.